Fox just reported the other day they were expected to make 78 cents per share. They made 74 cents per share. This is their earnings release from their website. They reported revenues of $3.03 billion and net income of $308 million. For the full year, they had revenues of $14 billion and net income of $1.23 billion. So it seems like a very consistent business in terms of quarter to quarter. Now, they did report increases in advertising due to much higher ratings than they expected, because that's how advertising goes. So it was a good year. So the question becomes, is Fox a buy? Now, my view on media going forward, I don't remember the last time I saw a commercial on something that was not a sporting event. Sports are very valuable. Fox is big on sports. Sports is valuable because nobody watches sports in replay. Everybody watches sports in real time. So it's a very valuable advertising model for companies, right? You've seen the value of sports teams skyrocket. Why? Because the advertising dollars have increased on these leagues, and the leagues get a check for these advertising dollars, and they share amongst the teams. So when they're getting all these checks because of big advertising dollars, it's helping. Going forward, do we believe we're going to see? I remember recently somebody saying, hey, have you seen this commercial? I said, no, I haven't seen a commercial in a long time. I pay for Peacock. I pay for Netflix. I pay for Hulu. And some of the Hulu stuff does have ads. And ads are starting to come back in other ways for other venues. And I get that. But I do believe that streaming, as you're paying for more and more, you're going to have less and less commercials. But for sports, it's absolutely going to be a factor in the future of having advertising during sports. You have people who like to spend money, and you have people with higher incomes all watching the sporting events. It's going to be very valuable to dollars. You have active eyes watching. We've even seen split screens where you see the sports going live here and ads on the left. It's going to be very valuable for advertisers to be involved with sports. Fox is big on sports. So let's take a look at Fox. This is our software. As you know, I'm Paul. If you're new to this channel, I'm a value investor. I use our 8-pillar process in our software to take a 500-foot view of a company and look at their quantitative aspects, the numbers of the company. If I like those, I dig deeper and look at the qualitative aspects of the company to see if I want to buy it. My goal as a value investor is to pay less than what I think the company is worth. I look for mispricings in the market. I look for companies that are selling for a discount to I think they're worth, and I try to accumulate shares because I believe in the short run, stocks are a voting machine. In the long run, they're a weighing machine, just like Warren Buffett says. So in the short run, some sort of negative news might cause a stock to go down, but usually it goes down much further than it should. And it also goes up much further than it should if there's good news out there. So my goal is to find mispricings. So if you're part of our software, if you pay for the monthly subscription, please follow along, but I'm going to pull up Fox here. So Fox is down slightly today. For the year, they had a high of 41 and a 52-week low of 29. Let's look at their max. Well, they just recently went public. It must have been a spin-off or something. So let's look at their income statement. All right, we do have 5 years of data. So we have revenues growing year over year. Let's go look at some of their main aspects here on our main metrics page. So a couple of things. One, healthy dividend here, 3.7%, pays out $300 million. Now, the reason we put this on our main page is, for those of you who've been a part of our channel for a while, everybody assumes that dividends are safe, and they're not. You have to compare the dividends paid to the free cash flow. Free cash flow we put right above it. But look at this. Last year's free cash flow was $1.6 billion, and over the last 5 years, their average was 1.8. So they can easily afford this $300 million dividend. They have a great return on invested capital, so the money invested in the business is getting a good return. And look, their 5-year PE, 11.5. It's pretty low. So let's go look at their actual 8 pillars here, and we'll go through it. All right, so look at this. A couple of the main ones. 5-year PE, 11.55. 5-year price of free cash flow, 10.3. They're buying back shares, which I like on cheap companies. Companies that have very low multiples, I like the fact the company's buying back shares, and they're saving this 3.7% dividend whenever they buy back their shares. They have revenue growth over the last 5 years. Net income's down about $1 billion, but cash flow's up $475 million in the last 5 years. So keep that in mind when you're looking at this. Like, net income could be down for any number of reasons. Let's go take a look at their income statement. So were there any write-offs in the last year that maybe jump out at me? Yes, right here. $509 million other income and expenses. When in previous years, they had a big one here, but they had $500 million gain, $45 million, and $2 million loss. So that's a big drop for their net income. That can help account for that difference. So from our perspective, I'm looking at Fox. I'm going, okay, I like what I see here. So what's my next step? Well, my next step is to go in there and determine what I would pay for the company based on the cash flow and the earnings involved. How do we do that? our stock analyzer tool. We use the stock analyzer tool because every investment is the present value of all future cash flow. We don't know the future. So we have to make assumptions about the future and determine if we want to buy the stock or not. Now remember, our stock analyzer tool does not bring in the balance sheet as part of this. So here's what I think. Look at the balance sheet. I look at this number right here. I take our 5-year average free cash flow of 1.8 billion and I multiply it by 5. I want it to be less than, I want the multiple of long-term liabilities to be less than 5, and it is right here. Now, does that mean because there's 7 green checks you go buy? No. It means go put in the stock analyzer tool and see what it says. So we go to the stock analyzer tool. First things first, I'm picking number of years of analysis. I'm going to do 10 years. You can do 1 to 20 here. And then I'm going to put in my low, middle, and high assumptions for revenue growth, profit margin, and free cash flow margin, and then my ending PE and what my desired return is, and it's going to spit out a number for me. So let's start. And keep in mind, guys, this stock analyzer tool is literally the most important part of our software and the most popular. So even if you don't have our software, you want to understand how we do this, just rewind the video from this point to go look at my analysis and what I'm putting in. So revenue growth. They've done 8.3% a year for the last 5 years. So this is where we have to sit here and go, okay, where do we think the next 10 years will be? I want to be conservative. So I'm going to sit here and go 2, 4, and 6%. Actually, you know what? I'm going to do 2, 5, and 8%. The reason being is as time goes on and more media becomes sports related, I think the revenues will grow significantly on the advertising part for that. So I'm going to sit there and put in a high side. Let's say they grow 8% a year still. Profit margin. So in the last 5 years, they had 13%. Last year, they had 9% with that $500 million write-off. So I'm going to sit here and go with 10, 12, and 14%. Free cash flow. I like to keep free cash flow around the same as the profit margin. And here, they're pretty similar here. Yeah, a little bit off. So maybe I can do 11, 13, 15. Let's do that. 11, 13, and 15%. Now, earnings, PE ratio. Guys, historically, the average is 15. So with a company like Fox, I'm going to do 13, 15, and 17. And the same with the free cash flow multiple. And finally, for my desired annual return, I usually pick on big companies like this with a well-known brand name, 12.5%. Why is that? Well, I can get 9 or 10% by investing in a long-term ETF in the market. So I want a little bit of margin of safety. I'm going to put 12.5% in. I'm going to hit the analyze button. It's going to spit out 6 numbers for me down below, okay? Those 6 numbers will be low, middle, and high on earnings ratio and low, middle, high on the free cash flow ratio. If it's all green, that doesn't mean go out and buy. It means great, now go do a little more research. Go look at the company, go look at what they do, join our community, talk to people there. How realistic are all your assumptions here? Because if your assumptions are realistic and conceivable, then maybe it's a buy if it's all green. So we're hitting the analyze button, go down below. All right, not bad. So we have a low of the high 20s, a high of 70, and right in the middle, the low 40s. So guys, for a company like this tells me you might want to do more research on this one if you like these numbers. And the other thing is, add it to your watch list. Notify me when it goes below 30. Guys, I appreciate your time. If you like this video, want to learn more about our 8-pillar process, click the next video above to learn more and subscribe to our channel for more videos. Thank you very much.